Hi, it's Dak Hartsock, Chief Market Strategist, ACI Wealth Advisors and Process Portfolios, with a quick performance update on Process Portfolios October and year-to-date investment performance. Going to do this really quickly. I know Thanksgiving's coming up, and really there's better things to do than listen to me talk about the market, so we're going to get this out of the way very quickly. For those of you that haven't seen these videos before, when I'm moving through the material, if there's a slide that I got through a little too quickly for you, you can just hit pause on the player, read it at your leisure, and then hit play again and restart the video from where you left off. And that'll allow me to kind of move through the material a little bit faster. I know I have some executive type clients that are really interested in bottom line type stuff and not a big discussion. So I've organized this video so the material you're looking for, the bottom line stuff, is in the first about 2 minutes, 3 minutes. So without further ado, let's just go ahead and move into the presentation. If you do have additional questions when it's over or would like some additional detail, just go ahead and email me or give me a call at the office. So for those of you that don't know, I'm Dak Hartsock. I'm a nationally recognized, nationally cited investment expert, financial expert, and you can learn more about me at dakhartsock.com/about. For my executives, basically, the live portfolios are significantly outperforming benchmarks in 3 of the 6 portfolios so far for 2015 with about a month left. The core equity and durable opportunities models have been doing very well, and we had to make some changes to the way the core equity live portfolios were set up to bring them more in line with the models, and we did that in October. And some of the reasons why the live portfolios and the models don't always match up have to do with, when cash has been coming in, new clients, new accounts, that sort of thing, kind of skews the live portfolios away from the models a little bit. So at any rate, we brought the core equity back in line with the model in October, and as you'll see in a couple of slides, the October performance is really beginning to very closely track what the model is designed to do. So got some adjustments to make in durable opportunities as well, because the durable opportunities model is also doing very, very well for the year, but the live portfolios are not. And I'll give a little bit more color on that in a minute. Briefly, the recession probability indicator is still indicating a reasonably stable investment environment, and not saying that there looks like there's going to be a recession really anytime soon, subject to change. I update this about once a month for those of you that are interested. So let's move ahead. What I've got here is the consolidated live portfolio performance, October and year-to-date. I just want to point out a couple of things so that if you want to pause the video and look through each of these to get the bottom line, you'll understand what you're looking at. Right here, we've got the year-to-date for core equity, right? So the live portfolio is 1.8%, but the year-to-date model is 6.2%. So we made the changes to this portfolio, and as you can see, they're already hitting, because October 15th, I think the model portfolio did something like 6.7% for the month, and this portfolio, or sorry, 7.7% for the month, and this is pretty close to what the model did. So it's approximately in line at this point. When you see these two numbers over here, these are just the benchmarks for that particular portfolio. So as you can see, different portfolios have different benchmarks, different kinds of model performance. But take a minute to look through this. You see we're doing pretty good. I also want to point out, basically every one of these models is taking on significantly less risk than just buying even an index fund. So there's the bottom line for those that are looking for it 3 minutes after the introduction, and if you'd like to stay around for a little more color, please do so. Here we have the core equity monthly performance. So we see that the model did 7.7% for October, and core equity did 6.9%, and that's really due to the changes we made in October to bring it in line with the model. So we expect this to put us on a pretty good footing for 2016, barring a recession. We should see, some outperformance versus the benchmarks and the stock market itself. And again, this portfolio, just buying the index fund at, say, the S&P 500, you're taking about 37% more risk than with our core equity portfolio. And now that we're in line with the model, you can see there's some pretty serious outperformance versus what you just get by buying the market. So market income, this has been our star for 2015. It's not only beating its benchmark, it's beating the model, it's beating the market, it's beating everything, and it's doing so with considerably less risk. So we're getting some very good results with this portfolio. And as you can see, it's doing really what it's designed to do, perform with less volatility and risk than the market, and ideally about the same as a mixed stock bond portfolio, which is what this lightest blue line is. So that's kind of what we're seeing. Here we've got year to date for the market income, and as you can see, when the stock market itself is at less than 3%, and you've got over a 9% number here so far, that's pretty good. We're also beating the index model here. That's the Chicago Board of Exchange buy right index. You can't buy that. There's no way to invest in it, but we built the market income portfolio along the same kind of strategy, because this is a good way to get consistent performance. It's a good place to have money and take significantly less risk than the S&P 500. This number here for the risk is a little disingenuous. It actually takes even lower risk than this, but right here towards the end of August, you can see took on a little more risk briefly because there was just a bunch of money on the table with one side of how this is managed, and we decided to take that money off. So it resulted in the portfolio being temporarily unhedged, which is why you see it drop like that. But then we get it back on somewhere around here, and it begins doing what it's supposed to do again. So moving on. Full cycle portfolio, I'll give you a little more detail on what this is later. In the slide I've got, or in the video, I've got a slide that will basically describe everything about this, but the bottom line is it's based on Ray Dalio's all-weather portfolio. For those that don't know, he's arguably the most successful hedge fund manager ever, and his all-weather portfolio manages tens of billions, hundreds of billions of dollars on behalf of endowments, pension funds, teachers unions, things like that. And it's kind of a risk parity model that's designed to do well, or at least preserve assets in every economic environment. And what we can see here is we're actually doing pretty well. We're a little bit off the model, but not by much. And here are the benchmarks, the closest benchmarks. So we're considerably outperforming there. So not bad results. This is kind of a tough year for this portfolio because bonds are going through a very difficult phase and will continue to do so until interest rates approximately normalize. And as you know, commodities have had a very difficult year, and of course, as a strategy that's designed to do well in all kinds of economic cycles, it does have bond and commodity exposure, relatively significant. So durable opportunities. This model really needs some, not the model, this portfolio really needs some work. We're going to be working on this the next couple of months to bring the portfolio back in line with the model, so that we ideally are going to get some better results in 2016. And as you can see, we've got some pretty serious lag. We made a couple adjustments, so it's doing a little bit better here and there. Part of the difficulty is one of the main holdings that we had, Precision Cast Parts. We bought it at a good price, and then Warren Buffett came in and took it. So we never really got the capital appreciation, out of that holding that we were expecting. And then you combine that with the fact that one of our other, long-term holdings is Exxon. We had some pretty good exposure to that and bought it at what we thought was a good price, and probably still is longer term. But in the short term, with what's happening with oil, Exxon's really hurt us. It's almost single-handedly responsible for what we see here. And considering that the model is doing very, very well for the year, it's time to start working on bringing the live portfolios in line with the model and position us for a better 2016. Market momentum. This is a strategy that I've used previously, but never as a discrete portfolio. So I went ahead and put that in place over the summer, and it's doing very well. Much like market income, it's beating its model index, which is the CBOE buy right. It's got a couple of tweaks to it, so it should be worth about 2 to 3% more per year, year in, year out, than the BXM. And you can also see that, not so much month to date, but if we bounce over to since inception, it's considerably outperforming, these kind of benchmarks, and considerably outperforming the model, approximately in line with that, extra 2% or 3%. What's interesting, it's also doing this for, considerably less risk than just buying the index fund for the S&P. So that's a great outcome so far. Fixed income, here's our challenge. I do believe that 5 out of the 6 portfolios that are managed here at Process Portfolios and ACI Wealth Advisors should be outperforming their benchmarks, should be outperforming the market. In most cases, not always. Fixed income is not one of those portfolios. This is just a bad time for fixed income, for bonds. Interest rates are going to rise. Everybody knows it. And if you are buying heavily into bonds, at some point you're kind of guaranteeing that you're either going to have a loss in terms of real returns due to inflation, or you're going to have to take a principal loss to get out of the position and reset it. So we've actually got half this portfolio in cash. It did better in October, tweaked a little bit here and there, but still not really what we're looking for. If we look at the year to date, we've got some lag here. So there's going to be some more tweaks to this in the first quarter next year to see if we can up this performance a little bit. Again, we don't have much money in this portfolio, and what money is in it is 50% cash because it's just a bad time for bonds right now. There's a lot of risk and not a whole lot of upside. So let's move on. Here's some quick summaries. I'm just going to bang through these, and if you want to read more, you can just hit the pause button on the video. So I'm going to go ahead and move through these, and you can read about risk management and benchmarks and all that other stuff if you like. And that is pretty much what we've got here. Thanks for the time. Happy Thanksgiving to everyone. Hopefully I'll get a chance to talk with some or perhaps all of you over the next couple of months. And enjoy the time with your families. As always, feel free to reach out if you've got questions or would like some more detail. Thanks very much.